Rhodium isn't just expensive, it's dangerous for beginners. You might see headlines about skyrocketing prices and think it's safe, exclusive, or a can't-miss investment. But here's the brutal truth: high price doesn't mean low risk. One tiny mistake, buying at the wrong moment, misreading a spike, or assuming liquidity like stocks, can wipe out your capital faster than you can react. Most beginners don't realize they're walking into a trap that feels exciting at first, then punishes without mercy. And that trap? It's called rhodium. Rhodium can destroy beginners for one simple reason: its price creates false confidence. When beginners hear that rhodium is one of the most expensive metals in the world, their brain automatically connects high price with safety. They assume that if something costs more than gold, it must be stable, reliable, and smart to invest in. That assumption is dangerous. In the United States, many new investors fall into this trap. They see headlines about rhodium prices exploding, or charts showing massive gains in a short time, and they mistake price for protection. But price alone tells you nothing about risk. Rhodium is expensive because it is rare and difficult to produce, not because it behaves like a mature or stable investment. Its market is extremely small compared to stocks, ETFs, or even gold. There are fewer buyers, fewer sellers, and very limited transparency. This means price moves can be violent. When demand spikes, prices can shoot up quickly. But when demand disappears, prices can collapse just as fast. Beginners enter this market feeling confident. They believe they are buying something elite or exclusive. What they don't realize is that high-priced assets magnify mistakes. A small error in timing, a small shift in demand, or a sudden market shock can wipe out a large portion of capital very quickly. Rhodium doesn't hurt beginners because it's a bad asset. It hurts them because they confuse high price with low risk. And in investing, that confusion is one of the most expensive mistakes you can make. Another reason rhodium can destroy beginners is that it is not a normal investment market. Most beginners come from stocks, crypto, or ETFs. They are used to liquid markets where prices update constantly. Buyers and sellers are everywhere, and exiting a position is usually fast and simple. Rhodium does not work that way. Rhodium trades in a very thin and specialized market. There is no centralized exchange like the stock market. Pricing is not fully transparent, and trading volume is extremely limited. In practical terms, this means a small number of participants can influence price movements far more than beginners expect. For US investors, this creates a dangerous mismatch in expectations. Beginners assume they can buy and sell rhodium with the same ease as a stock or ETF. They believe liquidity will always be there when they need it. But in illiquid markets, liquidity disappears exactly when fear appears. When prices rise, everything feels calm. When prices fall, spreads widen, buyers vanish, and selling becomes slow and expensive. This is where beginners panic. They realize too late that rhodium is not designed for frequent trading or emotional decision-making. Rhodium rewards patience, expertise, and deep market understanding. Beginners bring speed, emotion, and assumptions from other markets. That mismatch is why rhodium feels unpredictable to new investors, even though the risk was always there from the beginning. Rhodium hurts beginners because its price spikes create the illusion of a trend. When beginners see rhodium prices suddenly surge, their brain assumes something fundamental has changed. They believe demand will keep rising, and that getting in late is still better than missing out. This is a classic mistake. Rhodium prices often spike due to short-term supply disruptions, not long-term investment demand. Issues like mining shutdowns, geopolitical risk, or temporary industrial shortages can push prices up very quickly. But these events do not create a stable trend. They create temporary shocks. In the US, beginners often confuse these spikes with the kind of momentum they see in stocks or crypto. They expect continuation. Instead, they get reversal. Once supply stabilizes or demand cools, prices can fall just as fast as they rose. There is usually no gradual exit window. Beginners buy near the top, not because they are careless, but because price spikes feel like confirmation. This is where rhodium becomes emotionally dangerous. It punishes late entries brutally. Rhodium doesn't move slowly. It jumps, and markets that jump rarely forgive timing mistakes. For beginners, mistaking a spike for a trend is one of the fastest ways to lose capital in rhodium. One of the most dangerous things about rhodium for beginners is how easy it looks to buy and how hard it is to exit. Buying rhodium feels simple. A dealer, a platform, or a product is offered, and beginners assume selling later will be just as smooth. It isn't. Rhodium has wide bid-ask spreads. That means the price you buy at and the price you can sell at are often very far apart. In calm markets, this difference is already painful. In falling markets, it becomes brutal. For US beginners, this is a shock. They are used to stocks or ETFs, where spreads are tight and exits are fast. They don't factor exit costs into their decision. When rhodium prices drop, dealers lower buyback prices, liquidity dries up, and selling becomes slow and expensive. This traps beginners psychologically. They hesitate to sell, hoping prices will recover, while losses quietly grow larger. Rhodium exposes a truth beginners rarely think about. Profits are theoretical until you can exit. An investment you can't exit efficiently is not flexible. It's a liability. Rhodium doesn't forgive investors who enter without a clear exit strategy. The final reason rhodium can destroy beginners is that it is not designed for them in the first place. Rhodium is a specialist asset. It was never meant to be a beginner-friendly investment. It exists in a narrow industrial ecosystem, with demand driven by specific sectors and regulations. Professionals who invest in rhodium understand its cycles, supply chains, and exit constraints. They treat it as a tactical position, not a long-term emotional hold. Beginners, on the other hand, enter rhodium with expectations borrowed from other markets. They expect stability, predictability, and constant liquidity. Rhodium offers none of those. In the US, many beginners are attracted to rhodium because it feels exclusive and misunderstood. But exclusivity increases risk, not safety. Without deep knowledge, patience, and risk control, rhodium magnifies every mistake. Timing errors become expensive. Emotional decisions become destructive. This doesn't mean rhodium is a bad investment. It means it is the wrong tool for the wrong hands. For beginners, the real danger isn't missing rhodium. The real danger is entering a market that demands expertise before experience. Understanding that difference can save more money than any tip ever will. Rhodium doesn't destroy beginners because it is dangerous. It destroys them because it is misunderstood. High prices create false confidence. Thin markets punish emotional decisions. Price spikes trap late entries, and exits disappear when beginners need them most. None of this is obvious at first. That's why rhodium feels exciting on the way in and unforgiving on the way out. The real lesson here is not to fear rhodium. The lesson is to respect complexity. Every asset plays a different game, and every game has a cost for entering unprepared. Beginners don't lose money because they lack intelligence. They lose money because they confuse rarity with safety and excitement with opportunity. The smartest investors don't chase the most expensive asset. They choose the asset that matches their experience, their patience, and their ability to survive mistakes. If this video saved you from one bad decision, it already paid for itself, because in investing, survival always comes before profit.